Hi everyone, I'm Vinnie Brown, real estate agent with Coldwell Banker, and I'm here today with Lori Roberts from Guaranteed Rate Affinity, and now we're going to get into the interesting part, interest rates.
Thanks for having me, Vinnie. Yes, there's a lot of news in the media. Media likes doom and gloom, and interest rates. Let's talk about when we're hearing all the time about the Fed and the rising rates.
Yes, let's start from the beginning, because a lot of people just don't even understand where an interest rate comes from and how it affects the mortgage rate.
Yes, well, the Fed, when they're talking about rising rates, it's the cost to borrow funds, which is more for businesses, for your credit cards, your car loans, a home equity line of credit. Those will be directly affected. The mortgage rate is tied to the bond market, and when the Fed when the Fed right now is trying to control inflation, and that is what really hurts mortgage rates. And so as the Fed raises rates, it actually can help the mortgage rates, because we're seeing control over that inflation, that we can maybe get that away from where it has been. And that will actually help mortgage rates. So it's not all doom and gloom.
Which is funny, because everybody is like, oh, put the brakes on buying a house because the interest rate is so high. But it's actually not. You're saying it's a fallacy.
It is. The media actually sits there on the news and tells you mortgage rates are rising because the Fed raised rates. Not true.
Okay.
And I want to scream at the TV when they do that. But it does have an impact. And we have seen rates rise. But that's more to do with the artificial holding down of rates because of COVID.
Okay.
And that was a once in a lifetime thing, or at least we hope so, right?
Right. Okay, so how do you determine, as my loan officer, what my personal interest rate is going to be when they're all over the place?
Well, a lot goes into that interest rate. The amount of money that you're putting down can have a determination on it. Your credit scores are a big piece of it. And if you're putting less than 20% down, your credit score actually has a bigger impact on your mortgage insurance. So those are all factors that go into that rate. And a lot of people like to shop on the internet for interest rates, like they do realtors. And I like to say one size does not fit all. That shopping for an interest rate on the internet is like shopping for shoes on the internet. You kind of really need to try them on for size, and that means, I think, someone local.
Well, local is a big thing. As a realtor, we love dealing with local loan officers, because otherwise you don't get anybody on the phone that's going to talk to you about what's going on. And I definitely think that that's the case.
You're not a number.
No.
You're a person.
Yes.
And Vinnie, you know where to find me, or whoever else you're working with. There's that accountability to the client and to you. We do have 3 types of loans, and there's more out there, but 3 main types of loans are the conventional loan, the FHA loan, and the VA loan. And conventional is majority of the loans that we see. FHA is a little more lenient on bumps in credit history. It's more lenient on debt ratios. And then VA are for our veterans. And that's 100% financing, no mortgage insurance, which, if you qualify for that, it's a huge thank you from all of us for your service.
So 100% means 0 down payment.
Exactly.
Okay. And now a conventional loan, most people think it's 20% down. So talk a little bit about the difference in even conventional loans as far as down payments.
Very good point. A conventional loan, you can actually put as little as 3% down if you're a first-time home buyer. 5%, 10%, 15%, 20%, and if you put down more, it actually can help your interest rate as well. But there are a lot of options out there, so it's not always one size fits all. It's helping your client find what's the right fit for them at this time in their life.
Okay, so now we have our credit in order. We have figured out our down payment and what loan we're going to go with. Now, how do we get that process started with, let's talk about pre-approval versus pre-qualification?
Great question. Pre-qualification is what you and I are doing right here. It's a discussion. You're telling me my credit score's perfect. My income is $100,000. My debts are $1,000 per month. and I can pre-qualify you for a mortgage based on that conversation. But to write an offer on a property, that pre-qualification won't work. A pre-approval is what you need. And a pre-approval is where either you do it online or we do it together on the phone or meet in person, and we enter in your income, your job, your down payment, and we pull your credit. And along with that, you're going to supply documentation to support your funds for down payment, your pay stubs, your W-2s, if you're self-employed, your tax returns. So I have something physical to base the decision off of. So we have all of that, then we run a computer approval. And that will tell us whether the loan's approvable or not. And things that can hold back an approval are, most of the time, it's not being able to verify the income or a credit issue. But from there, I would say a lot of people think, well, good, I'm pre-approved and I can get a loan. Well, there are certain things you need to continue to do once you're pre-approved, and that is continue to pay. Want to keep that pre-approval, want to be able to close on your loan, keep your credit the same. Don't open up any new credit. Let's keep things as close as we can to
Don't buy
what
a
they
car.
were. Thank you. How many times have you had that happen?
Don't buy a car. I went to a closing and somebody bought the car the day before we closed.
That changes things.
That changes
and they may
everything.
still be able to get the loan,
Right.
but it's going to delay things. So try and keep everything the same. And if you have something you need to change, like a job, okay, that could happen. We prefer it not to, because that again can delay.
Right.
But check with, let your lender know of anything coming up that you need to discuss. Don't just do it and say, oh yeah, did that matter? It can make or break your purchase, and we are not in the business of breaking hearts.
Yes.
So try and work with your communication.
Yeah. So first thing for me as a realtor is I'm going to come to you and just send you my client, and you're going to tell them what they can afford based on the initial basic information that they've given you. Then when we go to write the loan, that's when we need the pre-approval. And that's what you do, and you do it so well. So as always, great information. Thank you so much. And if you have any other questions for Lori or I, our information is on the screen.